Over the years, the office has found some governing bodies don't understand their role and the very different roles of management and the independent auditor. When these responsibilities aren't correctly understood, governing body oversight is lost, mismanagement frequently occurs, and auditors can't effectively complete the independent audit. So, what are the different financial reporting roles of the governing body, management, and auditor? Let's dive in. The governing body is responsible for everything in the entity. It hires management, adopts policies, and is directly accountable to the public. The governing body is ultimately responsible that the financial statements are properly created. It provides oversight and authorization. Management runs the day-to-day operations, and when we use the term management, we're referring to all the employees, including contractors, like accountants, attorneys, or engineers. Accounting is a management function and includes anyone who's completing data entry, performing bank statement reconciliations, or creating reports. State law requires management to follow generally accepted accounting principles, or GAAP, to prepare the financial statements. Remember, if operating a water system, for example, management needs to understand how a water system functions, including the laws, rules, and policies regulating it. To acquire that expertise, water companies hire or contract with an engineer or firm. The same principle applies to accounting. If the entity doesn't have, for example, an accountant, it's management's responsibility to get one. And part-time or on a contract basis is fine, but the entity needs access to this knowledge in order for it to properly comply with laws and standards. By auditor, we mean the independent financial statement auditor, not an entity's internal auditor. The auditor provides an independent evaluation of the entity's financial statements. The auditor works for the governing body, not management. Why does the auditor work for the governing body? Because the governing body hires the auditor to audit the financial statements created by management, to make sure management followed GAAP when it prepared the statements. The auditor follows generally accepted government auditing standards when determining if management meets GAAP requirements. Again, why are we making the distinction between the governing body, management, and the auditor? Because we've observed many governing bodies and some management that either do not understand their roles or willfully disregard their roles, and this affects the government's governance, operations, and the integrity of the financial statement audit. Let's discuss this further. One requirement is that management provides quarterly or monthly budget to actual financial reports to the governing body. These reports enable the governing body to ensure the entity is on track to only expend within what was approved in the budget, and to effectively accomplish planned projects for the year. If management is not correctly accounting for revenues and expenditures, these reports may be incorrect. This means the governing body is acting on bad information. For example, if financial statements are incorrect, a fire district could go into debt to purchase a new fire truck and plan to make debt service payments from funds that don't actually exist. This could require a significant reduction to operations, or a tax increase, or both, to make up the unexpected shortfall. This bad information problem, due to a misunderstanding of financial reporting roles, is further compounded when some governing bodies believe the auditor every year needs to correct or even create accounting records and prepare the financial statements as a part of the audit. This is not true. Management needs to correctly account for revenues and expenditures in the accounting system, such as Cassell, Polaris, QuickBooks, or even Excel, during the year, and then use this information to create the financial statements. This is management's role. When the independent auditor is hired by the governing body to audit the financial statements at the end of the fiscal year, those statements need to already be prepared. The auditor then asks questions of management and ensures those statements were prepared correctly, according to GAAP. Some governing bodies become frustrated when the independent audit is delayed because the financial statements need to be prepared, or because there are many adjustments that need to be made because funds were not correctly accounted for. This frustration should be directed at management, since it is management's responsibility to account for the entity's funds and prepare the financial statements that reflect what took place within those funds during the fiscal year. This is why one of our focuses in our fraud risk assessment questionnaire is each entity having a licensed CPA as a part of its management team, or at the very least, a person with a bachelor's degree in accounting. It's the responsibility of the governing body to hire qualified management to perform accounting functions and correctly prepare financial statements. If the governing body would rather have their manager focus on operations, that is fine. However, the board still needs to ensure a qualified accountant is providing accounting services and financial statement preparation. Another problem we observe too often is management selecting the auditor. Why is this an issue? If you guessed that this might create a conflict of interest, you'd be correct. How is there a conflict? Well, because the auditor reviews what management has done, namely, account for funds, then prepare financial statements based on that accounting. If management hires the auditor, then the auditor is reporting to the same person the auditor should be reviewing. This makes it extremely difficult for the auditor to be fair, objective, and independent. It also makes it difficult for the auditor to disclose concerns to the governing body. This is why the governing body hires the auditor, and the auditor works with management to gain an understanding of the entity's operations, but then ultimately reports to the governing body. This brings us to the Audit Committee. The Audit Committee should typically be a subset of the governing body that has a financial expert who is not a member of management. The Audit Committee, under the direction of the governing body, selects the independent auditor and receives reports on progress from the auditor. It also assesses the effectiveness of management's internal control program and tells management to correct deficiencies or resolve findings from the audit. This committee helps the auditor maintain independence and the entity to keep appraised of audit progress. In some entities, after the auditor presents findings of the review of the financial statements, the governing body or management asks things like, "So, how are we doing?" or "Do you think we'll be good for another year?" These are not appropriate questions to ask the auditor. Why? Well, the auditor's job is to make sure that there are not any material misstatements in the financial statements. In other words, the auditor objectively determines, with reasonable assurance, that the numbers on the financial statements reflect what actually took place in the entity during the past fiscal year. The auditor does not provide an opinion on how good or bad the numbers on the statements are. That is a subjective measure determined by the board and management when establishing financial goals and policies. For more information on all things local government, visit our local government resource center at auditor.utah.gov/resources.